Welcome everybody to another ITPM Flash. So I'm going to talk to you about Together in Electric Dreams today. What am I referring to? Well, generally speaking, I'm talking about the auto market in the US, but specifically the EV, the electric vehicle auto market, hence Together in Electric Dreams. On Monday, Ford announced that they're cutting prices on their F-150 Lightning Pro pickup by a fairly significant 17%, meaning the entry-level price is now at $49,995, just below $50,000. This partially reverses a series of price increases after the EV was initially listed in April of last year at $39,974. According to Ford, and this is a quote, "The EV market is rapidly changing and we need to adapt to remain competitive." I think it's an interesting move as the after effects of the COVID-induced supply chain disruptions work themselves through. In terms of the overall market, aggregate US auto inventory at the end of June was 1.95 million, which is a 71% increase year on year and is the highest since April 2021. It's the equivalent to 53 days supply compared to only 38 days worth of supply a year ago. Inventory growth within electric vehicles is even more pronounced. So with EVs, days supply got to 92.2 days as of June of this year, compared to 61 at the end of last year and 36 back in June 2022. The Mannheim Used Vehicle Value Index fell just over 4% sequentially on a seasonally adjusted basis in June. That's one of the largest one-month drops since the inception of that particular measurement in 1997. Wholesale prices typically lead those in the retail category by about 6 to 8 weeks. So what's the conclusion here? It's that we're seeing genuine price weakness in the used EV markets. According to some data sources, a 29.5% year-on-year drop in June alone, in addition to year-on-year drops of 9% and 17% back in January and March. For context, the overall used vehicle prices fell 3.6% from a year ago, but obviously the drops in the EV market are very much more exaggerated. Tesla price cuts have basically led the way. In the EV world, as of June of this year, second-hand Tesla Model 3s and Model Xs were selling at 30% and 21% discounts to their average June 2022 prices. Fairly dramatic, I think you'd probably agree. Now, you wouldn't necessarily associate the above fundamentals to be the case if you were just looking at Tesla's share price this year, which is up about 140%. The Ford Mustang Mach-E, the Tesla Model Y, and the Hyundai Ioniq 5 are all currently on sale, brand new, for immediate delivery with very generous manufacturers' incentives. A year ago, buyers were queuing up for the privilege of paying full price. As I say, the biggest inventory build has been in the formerly hottest segment of the auto market, EVs. So the EV market share of the overall market has increased quite a bit, but it's still only 7.2% of the overall market from about 4.6% in Q1 of 2022. However, production of EVs is rising even faster than sales. What about affordability? So comparing internal combustion engine vehicles with EVs. Between December 2019 and May of 2023, the average price for a new internal combustion engine car increased by 25% to $48,500. Now, despite Tesla's discounting causing a fairly hefty drop in average EV prices in the last 12 months by $9,370, in 2023, EVs are still 15% more expensive than traditional internal combustion engine vehicles. Even though the IRA, the Inflation Reduction Act, allows a tax credit of up to $7,500 on new EVs. That subsidy doesn't apply to all models. There are domestic content requirements and can be extended in full only to buyers with a tax liability of at least $7,500. Thus, the average EV price is still around $55,500, which is a $7,000 premium to your average normally fueled gas vehicle. So as we know, Tesla have added a significant amount of capacity into what was an already highly competitive environment. For example, they added capacity in Germany and Texas to produce the Model Y into what ended up being a much more competitive environment, meaning that they actually lost market share. As a result, they're now discounting really aggressively. And it's, of course, not just affecting Tesla, as we know from what Ford said on Monday. Now, out of interest, Tesla reports after the market later on today, which is Wednesday. On to another electric vehicle maker, specifically Nikola Corp, NKLA is the ticker. These guys are electric truck makers. Market cap is $1.8 billion. Short interest is 20% of the free float. The shares are up 17% year to date. Last week, they announced a deal with hydrogen gas producer Biotech, whereby they're going to purchase low carbon hydrogen and 10 transport trailers, whilst Biotech buys as many as 50 of Nikola's electric vehicles over the next 5 years. Of course, as is customary in these situations, financial terms not disclosed, the market wasn't bothered. They took the shares up by 61% in a single day on record trading volume of over 317 million shares. Now, this kind of leads us to a question, particularly when we look at the NKLA capital structure. Is there going to be a secondary share offering coming? So this company generated in Q1 revenues of $11 million, up from $2 million in 2022. Operating losses were 151 million, which was roughly the same as in 2022. Now, consensus on the street reckons that Nikola's operating cash needs are 1.1 billion through until 2025. Currently, they've got less than $200 million of net cash. Another basket case in the auto industry is a company called Carvana, ticker CVMA, famous for selling vehicles via giant vending machines. Market cap, $7.5 billion. Short interest, an amazing 44% of the free float. Before today, the shares were up 740% year to date. Since the market opened on Wednesday today, the stock is up currently about 25%, having been up even higher earlier on. Now, not so long ago, Carvana's capital structure looked destined for the scrap heap. Their share price peaked at 360 in 2021 and was less than $5 last December. The company is rated junk in terms of its credit. It's got a triple C minus credit rating. They've got $6.5 billion of long-term debt. Adjusted EBITDA for last year was negative $1.2 billion. Forecast for this year is about negative $44 million. The company has never made any money. In June, they tried to persuade their creditors to accept $1 billion debt swap that would have reduced their obligations. Later in the same month, management got the balls going by forecasting a positive adjusted EBITDA for Q2 of $50 million. Interestingly, one of the analysts at D.A. Davidson pointed out that the sales of accounts receivable is, and I quote, driving that move into the adjusted black. He believes it's likely one-time in nature. The RBC analyst commented, "We found management's commentary on returning to growth profitably while potentially exploring the capital markets as hard to reconcile given the existing debt load and the difficulty of maintaining an unprecedented fixed cost efficiency." Now, Carvana brought forward their Q2 earnings report to pre-market today, Wednesday. In conjunction with that report, they've announced a debt reduction deal of $1.2 billion and a distribution agreement to issue $1 billion of stock. The stock price we're strongly up pre-market, and it's strongly up now that the market has opened. The shorts are yet again getting squeezed. So what it looks like they're doing is they're swapping some debt for equity here. Now, what will be interesting will be to see at what price does this stock come to the market. We'll see how that situation and the others play out. But at the very least, I would not be a buyer of these stocks. Shorting them is clearly an extremely dangerous thing to pursue, so I wouldn't be shorting these stocks. But at the very least, I would not be a buyer of these stocks. Their fundamentals are divorced from their share prices and capital structures. This doesn't mean that they can't continue to rally, but as we used to say on the desk, if in doubt, leave it out. In other words, if I don't understand the valuation, or I can't reconcile it with my own realistic perceptions, I leave well alone. Thanks guys, see you soon.